Welcome to our How to Benefit from Federal Student Loan Debt Relief webinar. Various series of webinars that we have been hosting now throughout the spring. My name is Tommy Semanek. I'm one of the professional development specialists here with the Illinois Student Assistance Commission. Just want to go over a couple of housekeeping items before we go ahead and get into the content. This session is being recorded, as we all just heard, and it will be shared on our PD page of the ISAC.org site on the on-demand webinars section. So that'll be posted within a couple of weeks. If you or any of your colleagues you know that are on the call or trying to get on the call, if they can't hear me for whatever reason, they can always use the call me option. Bottom right-hand corner of your screen, there should be a little phone dial thing. You can go ahead and dial in via your phone to receive audio. You are able to ask questions throughout the webinar. We do have a Q&A section here where I have a variety of colleagues on the line that are able to answer your questions for you live, so feel free to use that throughout the webinar. And unlike some of our other webinars that maybe you have attended in the past, we are not offering continuing education credits and professional development hours for the webinar. We will be posting an evaluation in the chat still at the end of the webinar. We would love to hear your feedback. But we will not be offering CE and PD hours. So I'd like to go over this just a little bit in terms of we have some folks on the webinar maybe who have not heard of ISAC before. Our mission is to provide Illinois students with information and assistance to help make education beyond high school, whatever that might be, more accessible and affordable. The state also administers a variety of scholarships and grants to students across our state. And then us here at the professional development team here, a lot of the trainings that we offer are on navigating anything really in the financial aid process. We've done a variety of FAFSA simplification webinars throughout this year, for example. We've been quite busy with that. Also hosting sessions about resources and supports for our underrepresented students and understanding student loan repayment and forgiveness programs. And that is something that we'll be touching on a little bit today as well. So here is our agenda for today. We're going to do just a couple of slide walkthrough of the income-driven repayment plan, since this is an IDR payment adjustment. And then I'll go through that adjustment overview, how this works and what they're going to do. And then we'll talk about some of the impacts to public service loan forgiveness and consolidated loans, or maybe for those who have not yet consolidated if they need to. We'll go over then some frequently asked questions and provide answers for those. And then I'll go through some general resources for all of us to be aware of. All right, we'll go ahead and dive into a little bit of details on the income-driven repayment plans. So the income-driven repayment plans are designed to set your monthly payment amount as an affordable rate that's intended to be based on your income and your family size. And because of that, hopefully then it becomes a more affordable option for you on a monthly basis. It's designed as well for after the time you reach the end of your repayment period. Say it's 20 years, right? It kind of gives or take depending on the plan. Any remaining balance you have on that loan or any of those loans is forgiven. So, say you have $30,000 worth of debt, you're on one of these income-driven repayment plans, you've been paying for 20 years, it's on an affordable rate for you based upon your income and family size. If you got that balance still left over after 20 years, the rest of that amount is forgiven. So it can be a nice option for some of our borrowers. Now, the income-driven repayment plan term is usually used as an umbrella term to describe a variety of plans, and it has gone through some changes in recent years. So we see here we have the pay-as-you-earn plan, the new SAVE plan, which is saving on a valuable education. That's formerly known as the revised pay-as-you-earned plan, or the repay plan. So repay is no more, it has been replaced with SAVE. We then see income-based repayment and the income contingent repayment. The difference between these is really going to be what they're going to count as income in terms of if you're married or not. Could be the types of loans you have. For example, the SAVE, pay, and the ICR plans, you're going to have direct loans or direct consolidation loans. And also the time period in which you are paying off your loans is a little bit different as well. We'll go through a couple more details in that on the next slide. Keep in mind that borrowers have to apply for these repayment plans. You're able to do so on the studentaid.gov site. you can kind of play around with the plans, and I'll talk a little bit about the federal student aid estimator tool. It gives you sort of an idea of, all right, is this plan going to be affordable for me? Am I capitalizing interest a lot over the long haul? Or am I going to have a balance that's going to be forgivable at the end? So you can kind of play around with those details and make kind of the best decision for yourself as a borrower. So a little more details here on comparing the different types of income-driven repayment plans. A couple of questions you want to ask yourself, right? So which payment plans are you eligible for, right? In terms of the type of loan that you might have. We talked about how only the IBR plan would allow, say, FFEL or Stafford loans, etc. And should you consolidate your loans or not? That's another good question to have as well. If you want to be taking maybe an advantage of the save plan or the pay plan, if that's an easier, maybe more affordable plan for you, perhaps you want to consolidate into a direct consolidation loan. And then what are your payment terms, right? You can see here on the screen here the variety of plans that have different percentages of your discretionary income. So for save, pay, and IBR, I'm seeing it's 10% of the discretionary income here versus IBRs prior to 2014, they have it paying as 15% of your discretionary income. And the ICR plan has you paying 20% of your discretionary income. The different repayment periods and years on the right-hand portion of your screen here. So you can see here a lot of them, it's usually 20 to 25, again, depending on whatever kind of plan you have, is typically the terms in which you are paying off your loans. So that's how you can see those different plans. On studentaid.gov, it has all these full details here of exactly which loans qualify, what do they consider as income, and how long your repayment period will be. Now, with the income-driven repayment plans, it's going to be required of you to annually recertify your income and family size. So every single year, borrowers have to either manually or now with the new direct data exchange from Theft Simplification Act, you're able to now provide consent for the IRS to transfer tax information to the Department of Education to recertify income and household size. So unlike the FAFSA, right, where it is required for you to provide consent, not the case here for income-driven repayment plans. You do get the option to provide consent and have all that information automatically get transferred over, but you still have the option to manually enter this information when you recertify your information here. But if you manually do so, they're going to require you to upload some supporting documentation as part of the application process. Again, just to verify, of course, that the information you are reporting is accurate. Now, borrowers do have the ability to change your income-driven repayment plans, or you can ask for a plan recalculation here, depending on if there has been maybe a significant change in your income and your family size. And now you have the freedom to do this at any time you see fit. They do require you, of course, to do this on an annual basis, but say 6 months into the year, you have maybe, an emergency event that happens with you and your family, right? Maybe that causes a very significant loss in income, for example, right? At that time, maybe that monthly payment you've been making is no longer affordable for you. So you would ask for a recalculation at that time. Some supporting documentation would be required for, or maybe an additional application, and they'd be able to make that adjustment for you if there was that significant change. Talk a little bit now about consolidation here. Mentioned that a little bit. Consolidation allows borrowers to combine multiple federal loans into just one loan with just one monthly payment, one service lender, and one fixed interest rates. Borrowers have to apply to have their loans consolidated. An important piece about consolidation is that it is pretty complete and final, right? You can't reverse it after you do it. The only sort of window you get to sort of maybe cancel it or reverse it is the 10 days after they receive their summary statement. So you kind of get that small little window to maybe reverse this if you think you made a mistake or you didn't want to do this. Maybe there were some cons to it. But otherwise, once this is done, it is set and final. A couple of pieces about consolidation. Some pros would really be for those maybe interested in maybe taking advantage of one of those maybe more affordable income-driven repayment plans. Other borrowers consolidate for forgiveness program reasons. Myself and many of my team members on the call did consolidated purposes for public service loan forgiveness. Some cons for consolidation is really you see on your screen here that you lose access to that lower interest rate after consolidation. You might have 3 or 4 separate loans. They're all going to have separate interest rates. And when you consolidate, it takes the average of those interest rates. So if you had a loan or two that had a lower interest rates, perhaps when you consolidate, the average of those interest rates might be a little bit higher. So that's something to think about as well. Full details on consolidation on the studentaid.gov site. We do have that linked here. You can visit their site. Plenty of details there to walk you through any questions you may have. Of course, the Q&A feature is available here on this webinar. Okay, let's go ahead and get into the count adjustment here and some details about how this is going to work. So back in April of 2022, the Department of Education announced some steps that they were going to bring borrowers closer to forgiveness by updating their payment counts. This was intended to more accurately reflect a borrower's payment account. It has been currently underway since then. They are going to continue to do so until July 1 of this year, 2024. Now, they're going to be reviewing folks' accounts regardless of even if they are enrolled in an income-driven repayment plan or not. They're going to be actually reviewing all eligible loans. So this is going to be kind of a process they've been doing since April of 2022. They're trying to have more awareness to folks who maybe have been paying off their loans for 20, 25 years, but they never enrolled in an income-driven repayment plan. And they're trying to let them know, hey, listen, you've been paying off your loans for a while. You can receive forgiveness based upon some of these criteria here. Would you like to take advantage of that? So they're trying to do some review and some additional information, kind of transparency for borrowers to hopefully allow them to take advantage of these repayment adjustments and forgivenesses. So we'll see what happens. So who is this adjustment for? It's impacting borrowers, right? Either currently an income-driven repayment plan, or maybe they were in one in the past. Are folks who have taken advantage and are enrolled in the Public Service Loan Forgiveness Program. Or, again, like I mentioned in the previous slide, even if you're not in an income-driven repayment plan, but maybe they're interested, assuming they have eligible loans, meaning they have a loan held by the Department of Education, whether that's direct or the federal family education loans, they're going to review your accounts. Any borrowers with loans that have accumulated eligible time in repayment of at least 20 or 25 years are going to see automatic forgiveness, even if they are not currently on an income-driven repayment plan. So that is going to be hopefully maybe a big change and relief to some of our borrowers. How the adjustment's going to work, the Department of Ed is revising all borrower accounts with at least one direct or FFEL loan held by the Department of Ed, and identify all payments to be counted and instruct your loan servicer, whoever that might be, to make an update to your account. So Department of Ed has begun reviewing these loans that have been in repayment long enough to qualify, whether it's those 20 or 25-year periods. And they're going to review borrowers with at least one approved public service loan forgiveness form to update the months that could qualify for PSLF. I've seen my accounts, for example, be adjusted over time as I am part of the Public Service Loan Forgiveness Program and hoping for forgiveness maybe in the next 4 or 5 years or so. And number 3 here, the Department of Ed is going to review all eligible loans to update the months that qualify for IDR forgiveness. Again, even these folks who have not been enrolled in an income-driven repayment plan will see this be accurately reflected. So what loans are going to be eligible for the adjustment here? We have the full list of qualifying loans here. We have our direct subsidized and unsubsidized loans. Our direct plus loans, but keep in mind this has to be plus loans that you took out as a borrower, whether that may be you as a borrower, as a parent, and for yourself as a student. There's no way for direct consolidation loans. You can't combine parent plus loans with different student loans, the 2 different borrowers here. That's not going to work here. We have our direct consolidation loans we talked about, and then our direct parent plus loans that I just sort of explained with that consolidation piece. And then the FFEL loans owned by the Department of Ed. So those are our qualifying loans that are going to be eligible for this IDR adjustment. Now, if we have borrowers, maybe on the call, maybe you have commercially held FFEL or Perkins or health education assistance loans. These are loans not held by the Department of Education, but you may be still able to take advantage of this IDR adjustment. If you consolidate them into a direct consolidation loan, again, this would be held, of course, by the Department of Education by April 30th, 2024 this year. So that's just a little bit over a month away. If you do have commercially held FFEL, Perkins, or HEAL loans, and you consolidate into a direct consolidation loan by that April 30th, 2024 deadline, you can take advantage of that IDR adjustment. So that's a big piece here for maybe some of our maybe older, longer borrowers on the call who may have these commercially held loans. Account adjustment here for eligible borrowers. That account adjustment will include any months in repayment status. This is going to be regardless of payments made, the loan type, or repayment plan. So maybe these are late payments, for example. 12 or more months of consecutive forbearance, or 36 or more months in cumulative forbearance. Any month spent in economic hardship or military deferments in 2013 or later. Any month spent in any deferment except for in-school deferment prior to 2013, and any time in repayment or deferment forbearance, if applicable, on earlier loans before consolidation of those loans into a consolidation loan. Again, this is assuming that they, of course, consolidate by that April 30th deadline. Our borrowers with multiple loans. So, of course, borrowers, some of them have multiple loans that can reach forgiveness thresholds at different times, right? Now, borrowers may have one or more of their loans forgiven, but then still have then a balance left on their servicer's website and their accounts when they log in. So this may take several weeks for servicers to update their systems after the adjustment here. For example, even with the public service loan forgiveness adjustments they were making in the past, a lot of our accounts were just having zeros on them for payment counts. And a lot of folks were kind of freaking out, and they were letting us know, hey, it's just taking a couple of weeks for us to update it. Don't freak out about the zero. It's not zero for you. Don't worry. So kind of a similar situation here. Kind of give them some weeks to make sure that they update their systems, and be in contact with your loan servicers too. If you do have questions, they're going to be your best source to go ahead and get those questions answered for you. Talk a little bit now about the impacts to public service loan forgiveness and consolidated loans. Just a little bit of an overview here of what the public service loan forgiveness program is. It forgives the remaining balance on direct loans after making 120 qualifying payments under a qualifying repayment plan while working full-time for a qualifying employer. And the Department of Education in the last few years has identified or updated the definition of working full-time to be at least 30 hours per week. Now, this only applies to periods of repayment after October 2007, and that's because that's when the PSLF program began. So we'll walk you through a little bit now about the eligibility requirements and the application process. So first, for eligibility, you have to have eligible direct loans, right? This could be also a direct consolidated loan as well. You have to be employed full-time by either federal, state, local, or tribal government. A 501c3 nonprofit. This could be public educators, public library services, or another nonprofit that provides services to the public in some way. You also have to make 120 qualifying payments, meaning that you paid the full amount due for that month, and you have to be under a qualifying income-driven repayment plan or the standard repayment plan. Now, we always recommend, of course, you want to be under an income-driven repayment plan because the standard repayment plan, after 120 payments, has you pay off your loans, and then there's no balance left to forgive. So it's really good that you get under an income-driven repayment plan so that once you reach your 120 qualifying payments, there's still a balance left over for them to forgive. The application process has been simplified over the last couple of years, which we are happy to see. It is available on the PSLF help tool on the studentaid.gov PSLF section here. Pretty easy the way they've done this now for the help tool. It has you walk through nice and easy step by step on how to apply. Once that application has been signed and submitted, the loans will then be transferred to the PSLF servicer. Pardon the acronym misspelling there. But the PSLF servicer is Mohila. So when I applied, for example, I think my servicer was Nelnet, and the second I applied, they transferred everything over to Mohila. So some of you may have Mohila already. If not, and you were applying for public service loan forgiveness, Mohila would become your servicer. After making 120 qualifying payments for the program, Approved borrowers will then be notified, hey, you made your 120 payments and any balance left over that you have is now forgiven. So how does this coincide with the payment count adjustment? So the Department of Ed started making automatic PSLF payment account adjustments back in late 2023 for our borrowers who had eligible direct loans. Now, borrowers who consolidate will have their payment counts temporarily reset to zero. I mentioned that in a couple of slides about the systems kind of resetting there. Again, that's not saying that your payment counts are at zero. It's just sort of a system reboot. Those PSLF counts will continue to be adjusted each month until the IDR counts for all federally held FEL and direct loans in late 2024, including those consolidated by April 30th, 2024. So like myself, for example, I've seen some adjustments in my PSLF account. And I may see another adjustment even after the April 30th deadline here, once they, of course, continually kind of review every single one of these accounts for all of these eligible loans. I may see another adjustment to my account. I might not. We'll have to see. But you want to make sure you're using that PSLF help tool to recertify your periods of employment and tracking your progress. We like to recommend doing this as well on an annual basis, just so you have an accurate count of where you are in terms of how many qualifying payments you have to reach public service loan forgiveness. I mean, everyone can make mistakes too, so I'll talk about a little bit later about how you can submit a complaint to the Department of Ed if you think there's an issue here, but doing so on an annual basis can really keep everyone in track and make sure that you are good to go on your way to that 120 count. Now, after the adjustment in 2024, all periods credited towards the IDR will also be credited towards public service loan forgiveness as applicable, right? So trying to lead more borrowers to receive forgiveness through the program. So payment credits on consolidated loans for PSLF. So under those current PSLF rules, if you consolidate, the qualifying payments made on the new loan will be credited using a weighted average of those payments. In the past, this was not the case. If you consolidated, they had you restart at zero. And now they have changed with these new rules that they are now giving borrowers credited an average of those payments from consolidation. So that's been a nice change. So a little example here of how that would work, right? Say you have a borrower who has 60 qualifying payments and they consolidate their loan with another direct loan with 0 qualifying payments, right? So you get 2 loans, one's got 60, one's got 0. When they consolidate that into one, they now have a new qualifying payment count for public service loan forgiveness at 30. Take the average of 60 and 0. So that's credited towards the new consolidated loan, and now they would have 90 more payments to go in order to receive forgiveness. Now, for a limited time, the Department of Ed will allow qualifying payments from all loans, including those commercially or federally held FEL loans, to count towards public service loan forgiveness credit under the payment count adjustment without using a weighted average. So that's been a nice change. If you have that and you can consolidate by that April 30th deadline this year, 2024, they won't even take a weighted average. It'll just carry over those payment counts, right? But if you consolidate after April 30th, that new, of course, permanent rule of taking the weighted average after consolidated will then, of course, be in effect. So for joint consolidated loans, there have been some updates here in terms of the Department of Ed working and developing a process for loan separation for some of these borrowers to take advantage of public service loan forgiveness. But this was not going to be implemented until late this year, 2024. So borrowers, when the time comes, as they continue to work on it, are going to have to complete an application and sign a new master promissory note. Now, they are able to separate when the time comes via 2 different ways. Either they can submit a joint application, spouses, right? That's going to require each applicant to request loan separation of the joint debt. Or someone can file a separate application where only one borrower is needed to request loan separation that applies to only their portion of their debt. So this process, again, is not going to be available till late this year. Those interested now, they are encouraged to contact the Federal Student Aid Ombudsman Group or their loan servicer to indicate that they intend to apply for separation, kind of get them thinking about this. And then when the time comes, they'll have that process released where they can file either a joint or separate application. Okay, well, now go ahead and dive into some frequently asked questions and answers. So, do I have to consolidate by the end of April this year? Yes, you do. Only if you have commercially held FEL or Perkins or HEAL loans, right? So these are commercially held loans not held by the Department of Education. You can still take advantage of the adjustment if you consolidate by that April 30th deadline to benefit for that adjustment. So very important for these borrowers to consolidate by that deadline so they can take advantage of the IDR adjustment. Other questions. Can I qualify for a refund, or how do I even qualify for a refund? Well, this is for some borrowers if they made qualifying payments that exceed the applicable forgiveness period, then maybe they can receive a refund for their overpayment. So these refunds only apply for payments that were paid on the loan that is forgiven. Payments made on a loan that is included in a consolidation loan cannot be refunded. So if we have borrowers as well who have just already received forgiveness or they've already paid off their loans, you're not going to receive a refund for any sort of back pay. Your loans have been forgiven already, you've paid them off, you're done. So there's no going to be refunds for any kind of prior payments. This does include payments made before loan consolidation. So the refunds only apply for payments for more than 20 or 25 years worth of payments that were paid on the loan that is going to be forgiven. So that's going to be the difference here. So if you've already had that forgiveness, you've already paid off your loans, that's kind of it. You're done. So how will loan forgiveness impact my taxes? Because this is the federal government, obviously, right? We're dealing with more than just the state of Illinois. The federal government is not taxing loan forgiveness, but state governments might consider taxing it. Now, luckily, here in the state of Illinois, we don't have to worry about that. They are not taxing loan forgiveness. But other states have considered this and are doing so. So that has caused some borrowers, for example, when the Department of Ed comes to them and says, hey, you haven't enrolled in an income-driven repayment plan, but you could receive forgiveness if you take advantage of this adjustment here. Would you like to? Some folks may say no, and they have that option to do so because they don't want to get taxed on that forgiveness. But again, here in the state of Illinois, that is not something for us to worry about. The state does not tax loan forgiveness. Any debt forgiven because of the payment count adjustment, again, that does not recreate a federal tax liability for loans discharged between December 31st of 2020 and January 1st of 2026. The Department of Ed will notify you if they plan on discharging your loans because of the new payment count adjustment. And again, it gives those borrowers a 30-day period to opt out of automatic forgiveness if they choose to do so. What if I have a Parent Plus loan? The Department of Ed will forgive all Parent Plus loans that are consolidated or not that have accumulated 25 years worth of time in repayment. This includes borrowers under the PSLF program currently, during which the borrower was employed by a qualifying employer. If you, the borrower, have a Parent Plus loan and you do not reach forgiveness for either the IDR rules or the PSLF rules, then you will need to consolidate your Parent Plus loans by April 30th, 2024, and keep making payments under an ICR plan after consolidating to, of course, continue making progress towards forgiveness. What if my loans are in default? Talk about a little bit of the Fresh Start program. So borrowers with defaulted loans can get the benefits of the payment account adjustment by getting out of default, which would include our Fresh Start folks. That's a new program trying to get defaulted borrowers out of those negative consequences. So that Fresh Start was back in the pandemic. They had that one-time opportunity that provided these benefits to borrowers in default, which included the negative consequences of their credit reporting, and it also gave them access to affordable repayment plans, once again, those income-driven repayment plans, and to those loan forgiveness programs. Again, they have until September 30th this year, 2024, to take advantage of Fresh Start to try and get them rehabilitated out of default. So that is still going on. The deadline comes up here in the fall of this year. What if I have joint consolidation loans and I can't split this loan before the IDR adjustment? Talked a little bit about joint consolidated loans in previous slides. The Department of Ed will provide the same payment account adjustment treatment to any borrower who eventually splits a joint consolidation loan by consolidating their loans into a direct consolidation loan. So even if such split occurs after the date of the repayment count adjustment in 2024, that benefit will be applied retroactively. Again, this process is not going to be available really for these folks until the end of the year anyway. So that's how the Department of Ed is going to handle our joint consolidation loan folks. Okay, well, I'll go ahead and dive in through some general resources for all of us to be aware of. So I wanted to go ahead and just talk a little bit and mention here who the current Department of Ed held loan servicers are. This has changed in the last year or so in terms of there used to be quite a bit more, and they've sort of condensed and consolidated themselves over time as well. So we have Ed Financial here. Nelnet is one of the servicers I used to have. Mohila, that is the designated public service loan forgiveness servicer. Aid Advantage, ECSI, and then the default resolution group for our defaulted borrowers. So these are the current Department of Ed loan servicers. If you have Department of Ed held loans, these would be one of your servicers. If you don't know who your servicer is, the best way to figure it out is just to log into your studentaid.gov account. With your FSA ID, you go to the manage loan section and you can see where your balance is, and it'll have there indicated exactly who your servicer is. Once you figure that out, it's best to go to their site specifically and create an account or log in with your account if you have one already, of course, to manage your debt the best. And here's an example of what those learned servicer sites is. So here's Mohila. This is my servicer. This is the public service loan forgiveness servicer. So you can see here, right when you get to their homepage here on the left-hand portion of your screen is where they prompt you to log in or to create an account if you do not have one here. Once you do so, you get more specific information about your balances, what your plan is, where your payment counts are for IDR or for public service loan forgiveness, for example. All those details is best found here on your loan servicer's website. So again, unsure of where your loan servicer is here. Here's a screenshot of where you would find that here. I would, of course, log in to the FSA site here with my FSA ID, and I would go ahead and click on that Manage Loan and Grant section here, where I can go ahead and find my debt and exactly who my loan servicer is. Talk a little bit now about the FSA's loan simulator tool here. I have used this myself plenty of times. I've also used it with friends and family and folks I meet out in the field who have some specific questions that this tool can really, really help with. The first thing here is I want to find the best student loan repayment strategy here, right? And it depends on the goal and how you want to deal with your student debt. Whether it's you want to lower your student loan payments to have it to be the lowest monthly payment possible, or maybe you want to pay off your loans as fast as possible. You want to minimize capitalization, right? Minimize how much interest you're going to be accruing over time, which of course then increases your balance. And maybe you have that ability. Maybe you're going to be a little bit more of a higher income earner. You have got that budgeted out and you want to pay off your loans as fast as possible. It can walk you through how to do that. And it can also help you kind of determine, do you want to consolidate your loans or not? And what would be the benefits and the cons to doing so? So I always have people log into that and try to figure out, what's the best path for them. For me, for example, I'm trying to take advantage of public service loan forgiveness. So myself, I want to be the biggest balance possible to be forgiven at the end of my 120 qualifying payments. I want my monthly payment to be as low as possible. I can't afford a high monthly payment anyway, so there's that to consider. But for maybe you have high income earners, you're not going to be taking advantage of a forgiveness program. You want to pay, maybe want to pay those off as fast as possible. There are plans and there are ways to do that. In the middle section here, you're seeing I'm struggling with my student loan payments. What can I do? Right? Again, maybe you want to consider a new plan. Instead of just suspending your payments, getting into a deferment or a forbearance period, maybe just a new income-driven repayment plan will work for you. That new SAFE plan has really helped a lot of borrowers in terms of cutting down on the interest that borrowers are paying and only having it pay them 10% of their discretionary income. So that could be an option. It can walk you through, all right, if we switch your plans around a little bit based upon your income and your family size, would there be a difference here? Would it help you? You can also then, of course, learn about the impacts of suspending payments. So it does talk you through deferment and forbearance options, and of course explains why and how you should be avoiding default and the negative consequences associated with default if for whatever reason you were to get into default. The final option here on the third right-hand portion of your screen is to simulate more borrowing, right? So maybe you are a borrower paying off debt, but maybe you want to go back to grad school. Maybe you're trying to get a PhD, or maybe you're going to a community college to get another certificate, and you need to borrow some more money to go to school. What would that do to your debt? How would that affect your payments, etc.? It walks you through what that would look like for you. You can find out about different federal student loan limits then for yourself, and how your school choice and other things you do would affect how much you would need to borrow. So great tool here. Highly recommend using it for yourselves as borrowers. If you happen to work with students or families or professionals in the college going process, a great tool to use and kind of break down. All right, ISAC resources here. We do have federal student loan forgiveness page on our site where you can learn more about the one-time payment count adjustment. We have plenty of resource links there back to the Department of Education. We talk through other forgiveness programs as well. We're going to be hosting these webinars through the end of April here, right? So our next webinar coming up is going to be on March 26th at 3 o'clock. We do have a variety of more webinars coming in the month of April as well. So if you know folks who need to hear this information, have them go ahead to our website and register so they can see the information and join the webinars. I mentioned earlier in the presentation about submitting a complaint. Once your payment count is updated, as it's going to be throughout the coming months here, and if you look, you think there's an error, maybe you made more payments than what it says, you can reach out to your loan servicer or submit a complaint directly to the Department of Education. It does give you a section there on their feedback center where you can report issues with your payments, with your accounts, or maybe suspicious activities. A lot of folks with the issues, for example, with the new FAFSA and FAFSA simplification have used this to submit their complaints in terms of issues and technical glitches with the site. So a lot of ways here in different ways. If you need to submit a complaint, this is where you can do so. Also want to highlight being aware of scammers here, right? With a ton of new updates with the Department of Education here, lots of things going on in the news with student loan debt and the new FAFSA, for example. Scammers are on the rise, right? So don't trust anyone who's contacting you, promising you debt relief or loan forgiveness here, trying to charge you to receive loan forgiveness or cancellation for whatever reason. They really have a lot of good tactics. They try to look official with letters and logos and names, but you got to be aware and on the lookout for those who are trying to scam you. Again, if they're trying to ask you for money to receive forgiveness for whatever reason, that's a scam. Monthly fees to do work for you in this regard, that's a scam. Any promise of immediate forgiveness straight up, again, not true. It's got to be through a program, right? Or if they're asking you, of course, to provide your FSA ID, login information, username, password. No, that never is something you would do. You do not share that information with anyone. Okay, so now my colleague's going to go ahead and open up the chat. We're going to drop our valuation for today's webinar. Again, even though we are not offering CE and PD hours, we would still love to hear your feedback for today's sessions. So that is going to be due this Friday at 11:59 p.m., March 15th. So we give you just about 48 hours to complete the evaluation. It's going to be in the right-hand portion, bottom right-hand corner of your screen. I just saw her put it in the chat. It's that little chat bubble. It should pop up for you quite automatically. If not, bottom right